Welcome to Invert That. In today's video, we're going to explore one of the most misunderstood ideas in investing, intrinsic value. The purpose of this video is to understand how Warren Buffett and Charlie Munger thought about valuation, discounted cash flows, certainty, opportunity cost, and why the value of any business ultimately comes down to the cash it can produce over time.
Yeah, and it really is arguably the most foundational topic in all of finance. But paradoxically, I mean, it's the one that gets distorted the most by the modern financial industry.
I completely agree. And, to really do this justice, to actually strip away all these distortions, we aren't just looking at some generic textbook today.
Right.
We are pulling from a truly legendary stack of primary sources for this deep dive. We're going through decades of material. So we have the Berkshire Hathaway annual meeting transcripts stretching from 1994 all the way through 2022.
Which is just a gold mine in itself.
Totally. Plus, we've got Warren Buffett's early partnership letters, his famous Berkshire Hathaway shareholder letters, and some absolute gold from Charlie Munger's Wesco financial letters.
Yeah, the Wesco letters are incredible.
They really are. And the goal here is synthesis. Because normally, when you hear someone talk about financial valuation, there's this overwhelming expectation of mechanical precision.
Oh, absolutely. It's treated like structural engineering or something.
Exactly. An analyst plugs 50 rows of assumptions into a massive spreadsheet. The software spits out a target stock price to the exact decimal point, and they just point to the screen and say, there is the intrinsic value.
And look, that approach offers a tremendous amount of psychological comfort, right? It feels scientific. I mean, if there is a complex formula involved, we just naturally assume the output must be an undeniable truth.
Right. We crave that certainty. We want the financial equivalent of a medical x-ray that just points directly to the bland bone.
Yeah, but when you step into the world of Warren Buffett and Charlie Munger, and you actually read through thousands of pages of how they allocated capital in the real world, that whole illusion of spreadsheet precision it's completely thrown out the window.
It really is.
They present a landscape that is intentionally fuzzy. What's so fascinating is that while Wall Street obsesses over, daily stock price movements or complex volatility metrics.
On all that.
Exactly. But Buffett and Munger viewed valuation as a deeply logical but fundamentally imprecise process of judging future cash.
And the irony is that their method is far more grounded in actual business reality than the most advanced algorithmic model.
Without a doubt. So our mission today is to cut through the noise, bypass the Wall Street hype, and break down exactly how they practice valuation.
Okay, so let's start at the very bedrock. When you read through these letters, you quickly realize that Buffett's core definition of value doesn't sound anything like what they teach in a modern quantitative finance seminar.
Not at all.
So where did he actually derive his fundamental definition of intrinsic value?
Well, he goes back quite a bit further than modern finance.
Yeah.
Buffett explicitly points out that the true formula for intrinsic value hasn't changed since Aesop in 600 BC.
Wait, the Greek fable writer?
The very same.
So we are anchoring a multi-billion-dollar investment philosophy on a guy who wrote stories about tortoises and hares.
I know. It sounds absurd until you actually hear the logic. So in the 2000 Berkshire Hathaway shareholder letter, Buffett writes that the fundamental axiom of investment is Aesop's famous line, "A bird in the hand is worth two in the bush."
Okay.
That is the absolute nucleus of all investing. You are putting out cash today, giving up a bird that is currently sitting safely in your hand to get more birds out of the bush at some point in the future.
I mean, I love how ostensibly simple that is. But how does he translate a fable from 600 BC into a modern financial framework? Because two in the bush isn't exactly going to hold up in an audit.
Right. Well, he takes Aesop's premise and filters it through a concept developed by an economist named John Burr Williams.
Oh, the 1938 book.
Exactly. Buffett references Williams' book, The Theory of Investment Value, very specifically in the 1992 shareholder letter. And Williams provided the mathematical definition that Buffett adopted completely. That intrinsic value is simply the discounted value of the cash that can be taken out of a business during its remaining life.
Okay, let's pause and make sure we define that clearly for anyone listening. When we say discounted value, we're talking about the time value of money, right?
Yes.
So if I promise to give you $100 10 years from now, that is objectively worth less to you than $100 handed to you today.
Precisely. Because you could take today's $100, put it in a bank account, earn interest, and have way more than $100 in a decade.
Right. So future cash has to be discounted back to present-day terms to figure out what it's actually worth right now.
That's it exactly. You are calculating exactly how much you would pay today for the right to collect that future stream of cash. And notice what isn't in that definition.
What do you mean?
It has nothing to do with the accounting book value of the buildings the company owns. It doesn't matter how many employees they have or how many patents they hold or, the number of eyeballs clicking on their website.
Right, none of the metrics that Wall Street loves to hype up.
None of it. The only thing that dictates intrinsic value is how much actual tangible cash will this enterprise produce between now and Judgment Day, discounted back to today's present value.
To make that abstract concept incredibly visual, there is a brilliant analogy Buffett uses in the 1996 annual meeting transcript.
The bond analogy.
Yes. He says, whenever you look at a business, any business at all, I want you to imagine it as a bond that matures in 100 years.
And a traditional government or corporate bond is the perfect mental model for this because the terms are completely transparent.
Exactly.
A bond has physical coupons printed right on the paper, with absolute certainty that it's going to pay you, say, $50 every 6 months for the next 10 years, and then return your principal.
Right. So Buffett says, imagine you could magically see what the coupons, meaning the future cash flows printed on this business bond, were going to be over the next century. If you had a crystal ball and could see those printed coupons, you could just mathematically discount them back to today's value. The math for valuing a stock is identical to the math for valuing a bond.
It is. The underlying formula doesn't change.
But, okay, I have to push back here. If the underlying truth is that simple, if Aesop figured this out thousands of years ago, and John Burr Williams published the formula in 1938, and conceptually it is as easy as reading coupons on a bond, why is the finance industry so terrible at this?
That is the multi-million-dollar question.
Seriously, why do Wall Street analysts issue target prices that are wildly wrong all the time? Why is this seemingly basic concept so incredibly hard in practice?
Well, you've just hit the crux of the entire valuation problem. The practical difficulty is that, unlike a government bond, a business stock does not guarantee its coupons. When you buy a share of a company, the coupons are blank. The investor has to essentially print the coupons themselves based on their own estimates of what that future cash is going to be.
And estimating the future cash flows of a living, breathing, hyper-competitive business over a 10 or 20-year horizon is brutally difficult.
Exactly. As Buffett notes, the math of discounting is a cinch. A middle schooler can do the algebra. Figuring out the actual numbers to plug into that algebra, that is the monumental challenge.
Because the future is just completely opaque. Competitors emerge, consumer tastes shift, macroeconomic conditions change.
Yeah, and that brings us to a massive fork in the road regarding how you deal with that uncertainty. Because if predicting future cash is inherently flawed, how did Munger and Buffett avoid the trap that catches almost everyone else?
Right, because the standard Wall Street answer to uncertainty is just to build a more complex spreadsheet. You project out revenue growth, margin expansion, tax rates, all line by line for 10 years.
But if you read the sources, Munger sounds almost violently allergic to financial projections.
He really does. He views them with utter disdain.
Yeah, like in the 1995 annual meeting, Munger delivers a very stark warning. He states that to the extent that estimating future cash flow requires projections, those projections do more harm than good in America.
More harm than good. That is a staggering claim, considering that every single investment banking associate in the country practically lives and dies inside Excel projection models.
I know. But the psychology behind Munger's reasoning is brilliant. He argues that these detailed financial projections are almost never objective truths. They are persuasive documents.
Oh, that's such a good point.
Right. They're put together by people who have a vested interest in a specific outcome. Think about it. If a CEO desperately wants to acquire a rival company to boost his own prestige, he tells his finance department to run the numbers.
And shockingly, the staff inevitably creates a spreadsheet with aggressive growth assumptions that mathematically proves the merger is a fantastic idea.
Exactly. Munger calls the apparent precision of these projections fatuous or dishonorable.
Because the spreadsheet gives a false sense of scientific certainty to numbers that are, at their core, entirely guessed. It dresses up a subjective hope in the clothing of objective math.
It creates a really dangerous illusion, and Munger actually doubles down on this a few years later with an unforgettable metaphor.
Oh, from the 2001 meeting.
Yes. In the 2001 meeting, he compares modern corporate compensation and overly optimistic accounting systems, which rely entirely on these rosy, multi-year projections, to a farmer putting a rat colony in the granary.
A rat colony in the granary. That is such a visceral image. The very system that is supposed to be storing and measuring the value of the harvest is actively eating it from the inside out.
And the spreadsheets provide the perfect cover for the rats.
Okay, I follow the logic. But this presents a massive operational problem. If you fundamentally distrust detailed projections and you outright refuse to make precise multi-decade spreadsheets mapping out future revenues, how on earth do you actually value a business?
Right.
How do Buffett and Munger fill in the blank coupons on that conceptual bond if they refuse to project?
Well, the answer lies in their most famous mental model, the circle of competence. They simply don't try to predict the unpredictable. In the 1999 annual meeting, Buffett explains that they only attempt to print the coupons for businesses they deeply, fundamentally understand. It operates as a strict binary filter.
So if they don't understand the long-term economic characteristics of the business, they don't even attempt the valuation math?
Exactly.
Right, I remember reading those transcripts, and Buffett freely admits that he has absolutely no idea what Intel or, a high-flying software startup will look like in 10 years.
He has no clue.
He doesn't know what their cash flows will be because he doesn't fully grasp the technological shifts in the industry. He openly says Andy Grove, the legendary CEO of Intel, might be able to predict those coupons, but Buffett can't.
But flip that around. Buffett
Yeah.
says he has a tremendously high degree of certainty about a business like Coca-Cola or Gillette or a local water utility.
Because the underlying human behavior is so stable.
Exactly. He knows with near absolute certainty that human beings are still going to be drinking flavored water, shaving their faces, and turning on their taps a decade from now.
Yeah.
The competitive dynamics of those industries are incredibly stable. And because he understands the business deeply, he can estimate those future cash flows with a reasonable degree of confidence without needing a 50-page spreadsheet.
This philosophy completely upends how risk is traditionally taught. If you take an introductory finance class, risk is defined as volatility.
Right, beta.
Exactly. They use beta, which just measures how much a stock's price bounces around compared to the broader market.
Yeah.
So if the S&P 500 goes up 1% and a tech stock goes up 2%, it has a high beta. It's viewed as risky simply because the price chart is jagged.
And Buffett and Munger reject the concept of beta entirely. It's
Yeah.
just academic nonsense to them.
Which they mention quite a bit.
Yeah, in the 1993 shareholder letter, and he emphasizes this again heavily in the 1997 meeting, Buffett notes that risk is not volatility. A jagged stock price tells you nothing about the underlying business risk.
To them, risk is simply not knowing what you are doing. Risk is the permanent loss of capital.
So if they look at a business, say a promising new biotech firm, and they cannot estimate the future cash flows with a high degree of certainty, it's a no-go.
Instantly.
They don't try to adjust for the uncertainty by tweaking a formula or using a higher discount rate or building a probability matrix. They just throw it in the too hard pile and walk away.
And that discipline is their superpower.
Yeah.
I mean, they are perfectly comfortable ignoring 95% of the market. They only swing at the pitches they know they can hit.
Okay, let's play this out then. Let's say they find a business that is squarely within their circle of competence. They understand the product. They know the management. The industry is stable.
Okay.
They feel very confident they can estimate the future coupons. How do they perform the actual discounting math? Because again, reverting to business school doctrine, you are taught to use a risk-adjusted discount rate.
Right, the WACC. Yeah. The theory is that if you are valuing a very safe company, you use a low discount rate. If you are valuing a riskier company, you use a high discount rate to penalize it for the uncertainty. Do Buffett and Munger use risk-adjusted rates?
They absolutely do not.
Really?
No, and this is one of their most contrarian stances against modern portfolio theory. If we look at the 1998 annual meeting, Buffett explicitly states that they use the long-term U.S. government risk-free rate as their baseline discount rate.
Across the board.
They use it across the board for every single valuation.
Wait, I don't buy that. I have to challenge that logic.
Go for it.
If I am lending money to a volatile technology company, I am absolutely demanding a higher return than if I am lending to a municipal water utility. The tech company has a higher chance of going bankrupt.
Sure.
Shouldn't I demand a higher return and therefore use a higher discount rate for the tech company to compensate me for taking on that extra risk?
Well, your logic is exactly how the academic world thinks. But Buffett looks at it completely upside down. His counter logic, which he explains beautifully in that 1998 meeting, is that they don't use discount rates to adjust for risk because the risk assessment has already happened.
Ah, the go, no go filter we just talked about.
Precisely. If a business is too risky or its future cash flows are too uncertain, they don't try to solve that problem by changing the math. They simply don't buy it at all.
Oh, I see.
Right. If it passes the initial filter of certainty, if it is deeply within their circle of competence, then they assume the cash it produces is just as certain as the cash produced by any other business that passes the test.
So $1 of highly probable cash from a candy company is exactly the same as $1 of highly probable cash from a railroad.
Exactly. So they use the long-term government risk-free rate not as a measure of risk, but merely as a yardstick. It is a universal standard to establish comparability across all potential investments.
The government bond is just the baseline. It represents the absolute safest thing you could theoretically do with your capital. It's the ultimate bird in the hand.
Right. And this brings us directly into Munger's absolute favorite mental model, which he discussed at great length in the 1997 annual meeting, opportunity cost.
Oh, this is one of my favorite parts of the transcripts. Munger's dry humor really shines here.
It's hilarious.
He jokes that life is just a series of opportunity costs. He tells the shareholders that you married the best person who is convenient to find and who will actually have you.
Yeah, you don't hold out for an impossible theoretical ideal.
Right. You measure your options against what is actually available to you.
And it perfectly illustrates the financial reality of capital allocation. In investing, your opportunity cost is the absolute best alternative you currently have available.
So if you already hold a phenomenal asset in your portfolio, let's say you own a massive stake in Coca-Cola stock that you bought at a great price, or you have access to a government bond yielding 10%, you measure every single new idea against that specific baseline.
You don't need some theoretical hurdle rate invented by an academic. You just look at your own brokerage account.
Yeah.
If a broker pitches you a new investment idea, and it isn't demonstrably better, safer, or cheaper than simply buying more of the great thing you already own, you discard the new idea.
So Munger says people with a lot of good opportunities tend to make better investments because their threshold for saying yes is so incredibly high.
Yes. If your opportunity cost is a 10% risk-free bond, a new stock has to offer an almost absurdly high return to justify taking the cash out of the bond.
And this philosophy naturally leads to a highly concentrated portfolio. You only invest in the very best ideas that clear your personal elevated opportunity cost. You don't buy your 30th best idea just for the sake of diversification.
Exactly. It's a completely different way of viewing portfolio management.
Okay, so let's summarize where we are. We've established how they think about future cash. They estimate it only for simple businesses they deeply understand. They discount it using a standardized risk-free rate, and they filter everything ruthlessly through their opportunity cost.
Right.
But that brings up a massive practical problem. How do they measure current cash? Because throughout these decades of letters, Buffett is constantly warning us that reported accounting earnings, what Wall Street calls GAAP earnings, can be dangerously misleading.
Oh, this is a crucial distinction, and it really separates the amateurs from the professionals.
Yeah.
In the famous 1986 shareholder letter, Buffett dives deep into the anatomy of a business's earnings when discussing Berkshire's purchase of a company called Scott Fetzer.
Oh, right.
And he takes the time to explicitly break down the difference between GAAP accounting earnings and what he calls owner earnings.
Let's unpack the concept of owner earnings, because if you get this wrong, your entire valuation is doomed from the start.
Absolutely.
What is the formula he gives?
Well, Buffett defines owner earnings starting with reported net income, just to the bottom line.
Yeah.
But then you ADD back depreciation, depletion, and amortization.
Okay, let's pause there for anyone listening who isn't a CPA. Depreciation and amortization are accounting terms. When a company buys a big piece of equipment, like a delivery truck, they don't deduct the entire cost from their profits in year one.
Right, because the truck lasts longer than a year.
Exactly. They spread the cost out. They depreciate it over the life of the truck, say 10 years. So every year, the income statement shows a deduction for depreciation, but no actual cash left the building that year. The cash left years ago when they originally bought the truck.
That's it. So Buffett adds that non-cash charge back to get a truer sense of the cash the business actually generated that year.
But he doesn't stop there.
No, he doesn't. And this is the critical step. After adding back those non-cash charges, You then minus the average annual amount of capitalized expenditures for plant and equipment that the business needs just to maintain its long-term competitive position and unit volume.
So net income plus depreciation and amortization minus maintenance CapEx. Why is that subtraction of maintenance CapEx so absolutely vital? Where does traditional GAAP accounting lie to us?
The best way to understand this is through the example Buffett provides in that same 1986 letter regarding the oil industry, or really any highly capital-intensive business.
Right.
Let's say you own an oil company. Your accounting depreciation, which is the historical cost of your old drilling equipment spread out over time, is $1 million a year. So GAAP accounting deducts $1 million to calculate your profit.
Sounds fair so far.
But here's the reality. To actually replace your worn-out equipment today with modern technology at current prices, just to pump the exact same amount of oil you pumped last year, you actually have to spend $2 million in cash.
So GAAP allows you to report higher earnings because it's only looking backward at the $1 million of historical depreciation,
Right.
but your true owner earnings are much lower because you were forced to spend that extra million in real cash just to stand still.
You're running on a treadmill that keeps speeding up.
Yeah, I imagine a factory manager who has a machine that makes 10,000 widgets a day. The machine breaks. He has to spend $5 million on a new machine, not to grow the business, not to make 12,000 widgets, but just to keep making the exact same 10,000 widgets so he doesn't lose his customers to a competitor.
Exactly.
That $5 million is cash that the owners of the business can never take out and spend. It is trapped in the business.
That is the perfect way to look at it. If you value a business based on its GAAP earnings, without subtracting that necessary maintenance capital, you are going to massively overvalue the business because you are counting cash that you will never be allowed to keep.
It's fascinating because GAAP accounting can be misleading in both directions. It can overstate reality, like the oil company treadmill, but it can also severely understate economic reality, right?
Yes, and this is another concept Buffett had to invent to explain Berkshire's true value. He called it look-through earnings.
He talks about that a lot in the older letters.
He does, yeah. He explains it at length in the 1980 and 1990 shareholder letters.
Walk us through the mechanics of that.
So Berkshire Hathaway owns a mix of whole businesses, like See's Candies, and partial stakes in publicly traded companies. Let's take their famous investment in Coca-Cola.
Classic example.
Right. Berkshire owns roughly 7% to 9% of Coke over the years. According to strict accounting rules, because they don't control Coke, Berkshire can only report the dividends they receive from Coke on their own income statement.
So if Coke earns $1 billion in profit and decides to pay out $100 million in dividends to shareholders, Berkshire only records their tiny slice of that $100 million dividend check as income.
Exactly. But what happened to the other $900 million in profit?
Coke kept it.
Right, they retained those earnings. And what did Coke's management do with that massive pile of retained cash?
They reinvested it?
Yes. They built new bottling plants in Asia, they launched new marketing campaigns, they bought up regional brands. They reinvested that retained cash at incredibly high rates of return to grow the global value of the Coca-Cola enterprise.
And as a 7% owner of that enterprise, Berkshire is getting 7% wealthier because of that reinvestment, even though the accounting rules say Berkshire's earnings haven't changed.
Precisely. Buffett argues that those retained earnings are tremendously valuable to Berkshire. They are building future value. That's why he developed the concept of look-through earnings, to look through the accounting rules and capture the true economic value being generated on their behalf by their partial ownerships.
Which actually provides a brilliant organic transition to our next major theme.
Oh, yeah.
Yeah. We are talking about Coke retaining earnings and reinvesting them to grow. If a company is keeping its earnings to grow, Wall Street usually cheers. They love a growth story.
Oh, they eat it up.
But Buffett has a very specific and sometimes harsh view on growth, doesn't he?
He does, and it completely shatters one of the most pervasive myths in the investment industry. Wall Street treats growth and value as two completely different opposing investment styles.
Right. You are either a growth investor buying hot tech stocks, or you are a value investor buying boring, cheap industrial stocks.
Exactly. But in the 1992 shareholder letter, Buffett calls this distinction intellectually flawed. He says growth and value are joined at the hip.
Because growth is simply a variable in the intrinsic value equation.
Right. It's just a change in the future coupons. And growth can be positive, but it can also be a massive negative.
Which is so counterintuitive.
It is. Growth actually destroys intrinsic value if the business requires massive amounts of cash to grow, but only earns a low rate of return on that new capital.
And he uses the airline industry as the ultimate cautionary tale in that 1992 letter. It's such a brutal, hilarious takedown.
It really is.
He points out that over the decades, investors poured billions and billions of dollars into airlines to finance their massive growth. Buying more jets, opening more routes, hiring more pilots.
Expanding everywhere.
And the industry grew revenues tremendously. But the underlying economics of the airline business were so terrible, the competition was so fierce, that it was entirely profitless growth. He literally jokes that it would have been far better for the owners of capital if Orville Wright had failed to get his plane off the ground at Kitty Hawk.
It's a great joke, but the underlying truth is profound. If you are funding growth in a structurally terrible business, you are just throwing good money after bad. Yeah. You are putting $1 into a machine that gives you back 90 cents, and you are cheering because the machine is getting bigger.
Which leads Buffett to his ultimate conclusion in that 1992 letter about how to identify the spectrum of business quality. What makes a great business versus a terrible one?
He lays it out perfectly. The best business to own is one that can employ large amounts of incremental capital at very high rates of return.
Okay.
You put $1 into the business, and it generates 20 cents of true owner earnings every year forever, and then allows you to put another $1 in and get another 20 cents.
And the worst business?
The worst business to own is one that must consistently employ ever greater amounts of capital at very low rates of return just to stand still.
So you put $1 in, and you're lucky to get 2 cents back, but you have no choice but to keep putting dollars in, or the business collapses.
The treadmill again. So when Buffett and Munger are estimating intrinsic value, they aren't just looking at a static snapshot of current cash flow.
Right.
They are deeply analyzing the capital intensity of the business. Does this company need to constantly borrow money and dilute shareholders just to survive? Or is it a structurally simple business that spits out mountains of free cash that the owners can actually utilize?
Which is precisely why they love simple, consumer-facing businesses. They are infinitely easier to value because the owner earnings are obvious, the capital needs are low, and you don't have to guess about massive, unpredictable future capital expenditures.
Absolutely.
Okay, we spent a lot of time on the theory, the philosophy, and the definitions. I want to make this totally concrete for you listening.
Good idea.
Let's look at exactly how Munger and Buffett applied these valuation concepts to specific businesses within the Berkshire universe across different decades.
Okay.
Let's start with the crown jewel of their early acquisitions, the one that really changed Buffett's whole approach. See's Candies.
Oh, See's Candies is the ultimate masterclass in this philosophy.
It really is.
In the 1983 shareholder letter, Buffett reflects extensively on their 1972 purchase of See's. He notes a staggering statistic. See's was earning a whopping 25% after tax on its net tangible assets.
25% after tax, that is unbelievable. And they were doing it without using any financial leverage. They weren't juicing the returns with debt.
Exactly. But the key to the valuation wasn't just the percentage, it was understanding why they were earning that much.
Because it wasn't the physical assets.
No, the value of See's Candies wasn't in its physical assets. If you added up the value of the candy kitchens, the copper kettles, and the store fixtures, it was a relatively small number. The massive intrinsic value resided in an intangible concept Buffett calls economic goodwill.
And to be clear, we are not talking about accounting goodwill, which is just a balancing number created on a balance sheet when one company overpays for another. Economic goodwill is a real-world force.
It is the pervasive, fiercely loyal, favorable reputation See's had built with consumers over decades.
People just loved it.
Did. People loved the candy. They associated the iconic black and white box with holidays, romance, and joy, and the employees provided exceptionally friendly service. That intangible reputation created an almost impenetrable moat around the business.
Which gave See's massive pricing power.
Yes.
Let's talk about what pricing power actually looks like in practice. Because it means that every single year, around Valentine's Day or Christmas, See's management could raise the price of a box of chocolates by 5 or 10%.
Yeah.
And the consumer who is buying this as a gift for their spouse or their mother isn't going to suddenly switch to a generic, cheaper brand of chocolate just to save $2. The brand loyalty completely overrides the price increase.
That is the essence of it. And because they had that unchecked pricing power, Their cash flows were incredibly robust and completely insulated from inflation.
Wow.
Even better, returning to our concept of capital intensity, it required very little new capital to maintain or grow that cash flow.
Right, they didn't have to build massive new automated factories every year.
Exactly. A high-quality business like C's deserves a much higher valuation multiple because its owner earnings are huge, highly certain, and its capital intensity is practically zero.
See's is the perfect example of a simple, high-return brand. But Berkshire Hathaway is far more famous for its colossal insurance operations. Let's look at Geico and Munger's Wesco financial insurance arm, Westfike.
Oh, this is where it gets really interesting.
Right. In the 1995 and 1997 transcripts, Buffett makes a point of telling the shareholders that the intrinsic value of their insurance businesses is vastly higher than what is stated as their accounting book value. Why is the reality so disconnected from the accounting?
This entirely comes down to understanding the magic of float.
Float. This is the lifeblood of the Berkshire Empire.
It is.
Explain how float fundamentally alters the intrinsic value of an insurance company.
So in the Wesco letters from 1996 and 1997, Munger talks extensively about Westfike's entry into the supercatastrophe or supercat reinsurance business.
Okay.
They were writing policies to cover massive risks, like a hurricane causing billions of dollars in damage in Florida or an earthquake in California.
Huge potential payouts.
Right. But the core mechanic of the insurance business is that the customer pays you the premium money up front today, but you hold that money for years, sometimes decades, before you ever have to pay out a claim.
So if I buy auto insurance from Geico, I pay my $1,000 premium in January. I might not get into a fender bender until December.
Exactly.
For those 12 months, Geico is holding my $1,000. Multiply that by millions of drivers, and you have billions of dollars just sitting there. That pool of held money is the float.
And that float acts exactly like a massive loan to Berkshire Hathaway. But it's better than a bank loan because under the right conditions, it's an interest-free loan.
Actually, it's even better than interest-free if they underwrite profitably, right?
Exactly. If the total premiums Geico collects over a year exceed the total claims and expenses they eventually pay out, they generate an underwriting profit.
So they're getting paid to hold the money.
Yes. This means they are essentially being paid by their customers to hold and invest billions of dollars of other people's money. And in the meantime, Buffett and Munger get to take that massive pool of float and invest it in stocks, bonds, or whole businesses to generate tremendous investment returns.
So when you are calculating the intrinsic value of an insurance company, you can't just look at their underwriting profit for the year and apply a multiple to it.
No, not at all.
You have to value the long-term utility of having that expanding pool of free capital.
The float provides massive financial leverage without the traditional risks of taking on corporate debt. It fundamentally alters the economic reality of the enterprise.
That makes sense.
If an insurance company can reliably generate cost-free float, its intrinsic value is exponentially higher than what standard GAAP accounting or strict book value would suggest.
You know, this brings me to a really rare and fascinating moment in these historical sources.
Which one?
Well, we know Buffett and Munger absolutely hate giving exact valuation numbers. They famously refused for decades to tell shareholders what they thought the exact intrinsic value of Berkshire stock was because they wanted investors to do their own thinking.
Right. They never want to hand out the answer key.
But in the Wesco letters between 1995 and 1999, Charlie Munger actually broke his own rule. He gave the Wesco shareholders his exact step-by-step calculation of Wesco's intrinsic value.
He did. It is an incredibly rare artifact, and it serves as a brilliant example of how he applied his own logic in practice.
Walk us through his math, because he didn't build a complicated 20-year discounted cash flow model predicting Wesco's future revenues, did he?
No, not at all. He kept it incredibly grounded in present-day reality. He started by taking the after-tax liquidation value of Wesco's hard assets. This included their precision steel business, their real estate holdings, and their portfolio of marketable securities. He calculated what they would get if they sold it all and paid the taxes.
Very conservative.
Very. Then he added one very specific, highly tangible, intangible value. The value of the interest-free loan they were getting from the government.
Let's explain that government loan because Wesco didn't actually go to the Treasury and borrow cash.
No, it came from deferred income taxes.
Ah.
Wesco held a massive legacy position in Freddie Mac stock. They bought it very cheap, and it had appreciated wildly over the years. Because they had simply held the stock and hadn't sold it, they hadn't triggered any capital gains tax.
Right, you only pay the tax when you sell.
Exactly. So that massive unpaid tax liability just sat on their balance sheet. But Munger realized that until they actually decided to sell the stock, which they had no intention of doing, that deferred tax money remained in Wesco's account, earning returns.
So it was functioning exactly like a massive interest-free loan from the government, working diligently for Wesco's shareholders year after year.
So he conservatively estimated the ongoing value of that temporary tax advantage, added it to the liquidation value of the hard assets, and boom. He arrived at his intrinsic value per share.
And what was the number?
In his 1995 letter, he laid the math out and calculated the intrinsic value at about $149 per share.
What is the one input he completely ignored in that entire calculation?
The stock ticker. The market price of Wesco stock.
Exactly.
He notes in that same 1995 letter that Wesco stock was currently trading on the market at $182 a share. By his own math, grounded in absolute economic reality and conservative assumptions, the stock was selling 22% above its intrinsic value.
He openly told his own shareholders in an official accompany document that the stock was overpriced.
Yes.
That level of transparency is just unheard of in modern corporate America. No CEO tells their investors the stock is too high.
You'd be fired.
Seriously. But it perfectly illustrates the final and perhaps most important section of our deep dive today. Let's synthesize all of this philosophy, history, and math. What are the practical lessons that you, the listener, can take away from 50 years of Buffett and Munger's wisdom to apply to your own understanding of the markets today?
Well, I think the most important takeaway, lesson one, is to sever the psychological link between market price and intrinsic value. Never let the market price dictate your assessment of value.
Yeah.
This philosophy goes all the way back to Buffett's 1967 partnership letter, where he quotes his mentor, Ben Graham. Price is what you pay. Value is what you get.
Right. If you own a piece of a business, the blinking red and green ticker on your brokerage app is completely irrelevant to the actual cash that the business is generating on the factory floor or in the retail store.
It's totally disconnected.
The market is a manic depressive partner. It is there to serve you, to offer you prices to buy or sell, not to instruct you on what the business is actually worth.
Exactly. If the stock price drops 10% on a Tuesday because of a macroeconomic headline, but the business is still producing the exact same owner earnings, the intrinsic value hasn't changed a single cent.
It's just noise.
Just noise. And lesson two is arguably the cornerstone that keeps this entire philosophy safe. Demand a margin of safety.
Right. We saw this discussed heavily in the 1997 meeting transcript.
Yeah, because even if you follow all the rules, you find a simple business, it's firmly in your circle of competence, you understand the capital intensity, and you conservatively estimate the future owner earnings, you still have to protect yourself from reality.
Because no matter how rigorous your analysis is, your future cash flow estimates are guaranteed to be at least slightly wrong.
You cannot perfectly predict the future.
Yeah.
A competitor might launch a better product, a pandemic might shut down the economy. So if you calculate the intrinsic value of a stock to be $100 per share and the market price is $95,
You don't buy it.
you don't buy it. The gap is too narrow. You need a massive margin of safety. You want to buy that $100 of value for $60 or $70.
Because that gap protects you from your own inevitable errors in estimation and unpredictable bad luck.
Exactly. And lesson three brings it all home to how you interact with the financial industry. Ignore the noise and ignore the complex formulas.
Like we saw Munger relentlessly rail against in the 1995 meeting.
Yes. Never, ever rely on the seller's spreadsheets or an investment bank's 50-page projection deck. Do your own thinking.
Value simple businesses that you genuinely understand.
And utterly refuse to overpay for revenue growth that requires massive, low-return capital investments just to sustain itself.
So if we pull all these threads together, the core message of this entire deep dive is that intrinsic value is not a rigid spreadsheet exercise. It is a disciplined, highly rational philosophy of business assessment.
Well said.
It is about understanding a business's true, unvarnished owner earnings, ruthlessly gauging the certainty of its future cash flows, relentlessly comparing it to your best available opportunity cost, and then having the psychological fortitude to wait sometimes for years for a market price that offers a deep, undeniable margin of safety.
It is about recognizing that investing isn't about physics or advanced calculus. It's about business reality. It's about knowing the difference between a bird in the hand and a projection of two birds in a spreadsheet.
Okay, to wrap this up, let's leave you with a final puzzle to mull over. We opened the show by talking about how much we crave precision, how we want that clean medical x-ray giving us the exact answer.
Right.
And we've just spent an hour showing how Aesop and John Burr Williams prove that intrinsic value is, by definition, a fuzzy estimate of fundamental future cash flows.
So the provocative question is, why does modern finance still cling so desperately to complex, precise formulas if they know the future is unknowable?
It's a great question.
In the 2005 shareholder letter, Buffett actually calls out the famous Black-Scholes options pricing formula. For context, Black-Scholes is a highly complex mathematical model taught in every advanced finance class in the world, and it's used to price options contracts based heavily on short-term price volatility.
It's the ultimate example of academic math trying to conquer the market.
Exactly. But Buffett notes in that letter that he and Charlie believe Black-Scholes produces a precise number that is completely disconnected from the actual economic liability of those contracts over long periods.
Because it assumes a level of standardized volatility that simply doesn't exist in the chaotic real world of business.
Right. The spreadsheet gives you an exact, beautifully calculated answer that is totally, dangerously wrong when applied to reality.
Precisely. So the question for you to explore in your own investments as you look at your own portfolio is this. Are you seeking the psychological comfort of a precise formula that is fundamentally flawed? Or are you willing to do the hard, rational work of accepting a fuzzy estimate that is approximately right?
Are you looking at the clear X-ray of a broken machine, or are you willing to wade into the muddy, imprecise waters of actual business valuation?
Think about it the next time you see a price target. Thanks for joining us on this deep dive.